You're welcome to my channel. We want to talk about managing audit risk. In the earlier video, we talked about audit risk, and we said that audit risk basically is a risk that auditors, after the audit planning, audit testing, audit report, okay, they are going to be, invalid conclusions, right? Incorrect uh, incorrect submissions in the audit report, incorrect audit opinion, okay, and that applies to any auditor, whether environmental auditor, information system auditor, or financial auditor, or name the whatever kind of audit. You can arrive at wrong conclusions, okay, based on the three elements of audit risk, which we mentioned in the earlier video. So audit risk is a function of inherent risk, which is a risk due to the nature of that particular enterprise or process. Okay, we said in banking, all right, there's always a likelihood of fraud. In oil and gas industry, there's always a likelihood of accidents. Okay, so those are inherent to those industries. Okay, so you have control risk also. The risk that controls implemented might fail. So it's possible that the controls failed for technical reasons. It might fail because of collusion. For example, your staff, everybody agreed that yes, we are going to defraud this company. There's not anybody can do. Controls will definitely fail. All right. Then detection risk is the risk that is now resting on the auditor's decisions, competence, ability, all right, professional due diligence. So whether the auditors have done the right thing or not, okay, in the course of the audit will determine the level of detection risk. So detection risk is comes as a result of the actions or inactions of the auditors, okay, wrong choose choice of a wrong sample, um, wrong interpretation of an audit test, choosing wrong audit procedures, intervening the wrong set of people, right, not doing enough in terms of preparation. So all those can lead to detection risk. So the three of them, inherent risk, control risk, detection risk, will come together and create a mess, all right, for the auditors, which is called a audit risk. So, and that has caused a lot of embarrassment for many organizations, all right, in the audit profession. Okay, I don't want to mention names, but just go to Google auditors liability. You're going to see auditors getting fined. You're going to see auditors getting penalized. Okay, you're going to see auditors getting sued because of this concept of audit risk. So how can an audit firm or internal audit department manage audit risk? Number one, accept engagements with caution. So this apply to especially the external auditors. Okay, so it's not every opportunity that you should just grab. Okay, because there are some audit assignments that are going to rubbish you at the end of the day. For example, in financial auditing, there's what we call precondition to audit. So before you accept an audit engagement, you have to establish the fact that there are preconditions to audit. For example, number one, you need to ensure that the financial statement have been prepared according to the acceptable financial framework. All right, financial reporting framework like IFRS. Okay. Number two, you need to ensure that you have access to all information. All right, all information. Okay, that you need. All right, access to information, access to people. All right, access to documents that you need for your job. Okay. The number three, the auditor, the directors the directors of the business must also accept responsibility that they are the one that prepare the financials. So if those three are not there, all right, the standard says no, don't accept that audit engagement. So there are some. So you may need to gather information from even from outgoing auditors, so for you to better understand the environment of that audit, see whether it's a job that can mess you up on the long run. All right, so you do background check on directors. Very important. Still linked to the first point, accepting engagement with caution. So do your background check. Are they aggressive? Are they intimidating? Are they people that will not give you information? Are they people that can hold you to ransom with your audit fee? These are things that happen in real life situations, real life case studies. So you need to do your background check. All right. Are they clean? All right. Maybe they are using the company for illegal purposes, okay, like a money laundering and the rest. So you need to do those background check before you accept the auditor or the audit engagement. Then you need to train and retrain your audit team. Like we said, detection risk most of the time is because it has to do with competence, it has to do with experience, it has to do with exposure of the audit team. So you need to train and retrain your audit team members. Then you need to follow auditing standards. So there's a lot of all these auditing standards all over the place, international best practices on auditing. So you need to adopt and follow them. All right. Then clarify the engagement terms. Very, very important. You are going to be judged. You are going to be examined based on the terms of the audit engagement. So you need to be clarified, get clear understanding of what is expected of you or on the audit. Then, of course, KYC, know your customer, know your clients. So, what is the business? What is the mission of the client? What is the vision? All right. What is the what are their products? What are their services? All right. Who are their directors? What is the organizational structure? All right. What is the regulatory environment all about? Who are their customers? Who are their competition? So what application are they using? What infrastructure are they using? All right. What services? All right. Are they using? Who are their vendors? Who are their third party partners? So all those will help you to be able to have a good understanding of where challenges may come from, in the course of the audit. Then, of course, you need to have internal quality control, all right, as recommended by ISQC1. All right, International Standard of Quality Control One. That is the standard for auditing firms when it comes to the checks and balances, internal controls are supposed to have in place in the organization. All right, be extra careful on first-time audits, okay, because you are new in the environment. So because you are new in the environment, so many things may still be strange. So you must be extra careful. All right, check and recheck, do a lot of investigations, a lot of research, a lot of inquiry. All right. Maybe you can even bring another audit firm to come and recheck your work as part of the quality control efforts. Then you need to ensure independence. Okay. Once you lose your independence, maybe through familiarity with the client, through intimidation, through conflict of interest. All right, these are situations that can create a loss of independence. So once you have lost that independence, most likely there's going to be an audit risk, okay, because uh, you may be forced or compelled, all right, or cornered to ignore things that are very, very important. So you wonder a lot of time, why is it that all these organizations, businesses, multinationals that were failing, they had good auditors. So where were the auditors when all those infractions and irregularities were being perpetrated? So a lot of time is because of independence issue. In another video, I'm going to talk about auditors' independence and how to preserve them. Thank you.